Topic introduces credit value at risk, credit VaR, as a quantitative framework used to estimate the potential loss in a credit portfolio over a specified time horizon at a given confidence level. Credit VaR extends traditional value at risk concepts into the area of credit risk management by focusing on losses caused by defaults, credit migrations, and spread changes. Financial institutions use credit VaR to assess the overall risk profile of loan portfolios, bond holdings, and counterparty exposures. The model helps institutions estimate the amount of economic capital required to absorb unexpected losses. By quantifying extreme but plausible losses, credit VaR strengthens portfolio management and supports strategic decision-making. The topic further explains that credit VaR differs from market VaR because credit losses are often infrequent but severe and are influenced by long-term borrower behavior. Unlike market prices that fluctuate continuously, credit events such as defaults or downgrades occur less frequently and may exhibit strong correlations during economic downturns. Credit VaR models therefore incorporate probability of default, exposure at default, recovery rates, and asset correlations to estimate portfolio losses accurately. Time horizons for credit VaR are typically longer than those used for market risk measurement because credit quality changes more gradually. These differences make credit risk modeling more complex and highly dependent on assumptions regarding default behavior and correlations. A key topic is the importance of portfolio diversification and correlation in determining credit VaR. Diversification reduces overall portfolio risk when exposures are distributed across industries, geographic regions, and borrower types with low default correlation. However, during periods of financial stress, correlations among borrowers often increase significantly, causing diversification benefits to weaken. Concentrated portfolios therefore experience larger unexpected losses under adverse economic conditions. Financial institutions use credit VaR frameworks to identify concentration risk and evaluate how individual exposures contribute to total portfolio volatility. Stress testing and scenario analysis further enhance risk assessment by estimating potential losses under severe macroeconomic and financial environments. Topic also focuses on the major credit VaR models developed for measuring portfolio credit risk. One widely used framework is the credit metrics model, which evaluates credit migration risk by estimating how changes in borrower credit ratings affect portfolio value. Credit metrics incorporates transition matrices, default probabilities, recovery rates, and asset correlations to estimate the distribution of potential portfolio losses. Another important framework is Credit Risk Plus, which uses actuarial methods and probability distributions to model default frequencies and loss severity. KMV models rely on structural credit risk principles by linking default probabilities to changes in firm asset values and capital structures. Each model provides different perspectives on portfolio credit risk measurement. The topic also discusses the assumptions, strengths, and limitations associated with credit VaR models. Credit metrics provides detailed analysis of migration risk but depends heavily on accurate transition probabilities and correlation estimates. Credit Risk Plus is computationally efficient and suitable for large portfolios but may oversimplify relationships among defaults. Structural models such as KMV incorporate market information effectively but rely on assumptions regarding asset volatility and firm value dynamics. All credit VaR models face challenges related to limited historical default data, changing economic conditions, and the difficulty of estimating default correlations during crises. Institutions therefore combine quantitative outputs with professional judgment and ongoing validation to improve model reliability. Finally, topics emphasize the critical role of credit VaR in modern credit risk management and capital allocation. Financial institutions use credit VaR to estimate unexpected losses, determine economic capital requirements, evaluate concentration risk, and support regulatory compliance under frameworks such as Basel. These models improve transparency by providing standardized measures of portfolio credit risk and enabling comparisons across business activities. However, credit VaR should not be viewed as a precise prediction tool because extreme market conditions and systemic events can produce losses exceeding modeled expectations. Effective risk management therefore requires integrating credit VaR with stress testing, governance oversight, diversification strategies, and comprehensive credit analysis.